I recently made analysis videos for Amazon, Alphabet and Microsoft, and I think, as you all know, a lot has changed in the past weeks. So Amazon, for example, the stock dropped over 20% last week. Therefore, I will now give you a quick update on the stock price and see if the valuation has changed. We can see right now Amazon is trading at $103 per share. I do my valuations based on the free cash flow of the company. I have different growth scenarios, a normal case, a best case and a worst case scenario. I like to do this because I care a lot about the risk and reward of a stock. I want a low risk and a medium or high reward. I think the growth assumptions for Amazon are conservative. In the worst case, I still see the company growing because of their high margin businesses of AWS and the advertisement business. Those are growing in the mid double digits, and as they are growing faster than the retail business, I believe that the free cash flow and the company's margins will go up. And given that the AWS business kept growing with 28% year over year, I think 15% and then slowly declining it over time is very conservative, and therefore it's a reasonable worst case scenario. We can see this is still in line with the market, so I'm quite happy with the risk, and the reward looks very good. When Amazon's actions of cutting costs and reducing the number of employees, when those pay off, you will see the company's free cash flow jump higher because they currently have operating expenses very high and also capital expenditures very high, and this is something that they definitely are able to reduce. When we look at the expected annualized return, keep in mind this is no financial advice and you have to do your own decisions. This is a method that works for me and that I personally follow, but you have to make your own decisions. I believe for the next years we have a possible internal rate of return for Amazon of 15.2%, which looks very nice to me, and I will definitely keep my position in Amazon. Let's take a look at Alphabet. We know something that is special about Alphabet is that they have very huge free cash flow, they have high margins, low debt, a lot of cash, and the number of shares outstanding is constantly decreasing because of their huge buybacks. Currently it's trading at $96 a share, and I think the growth estimates are very conservative, especially if you look at the cloud business of Alphabet, which kept growing with nearly 40% this quarter over quarter, and they aren't profitable with it yet. But once they manage to break even, we will see a huge jump in free cash flow. But this isn't even reflected in those growth rates. Let's take a look at the worst case scenario first. We can see just 8% growth. Those are analyst estimates, but from here just 8% growth and then slowly declining it to 7% with a very high free cash flow yield of 7%, and we still get an internal rate of return of 11.8%. This looks very nice to me. And if you take a look at the best case, still low double-digit growth, 17%, and even reducing it to 13% in 2030, but we get a 20% internal rate of return, which would mean a 4 or 5 bagger. The possible internal rate of return for the stock, if we combine those results, is 16.8%. It looks even better now. I looked at the quarterly earnings results in detail, and I actually liked what I saw. And therefore I like the stock now even more than before the earnings results. Which brings us to the last company for today, Microsoft. We can see the share price is currently $235. The number of shares outstanding is also constantly decreasing. We have nice revenue growth. We have nice free cash flow growth. We have low debt and a lot of cash. Let's take a look at the worst case first. I will let it grow a little bit higher than Alphabet because they don't depend as much on the advertising segment. Microsoft is well diversified, and I see it as such an important business for companies, and what they are currently doing with their cloud business and all of their software as a service models is just very good. That's a great job from the management. Therefore they deserve a little bit of a premium when it comes to the growth rates and a little bit lower fair free cash flow yield. We see Microsoft is a little bit higher valued than Alphabet, and we get an internal rate of return of 7.8%. Therefore also the best case is a little bit less than Alphabet, but also very nice with 16.8% internal rate of return. I think this premium is well deserved for Microsoft. It's a high quality company. They have so many different segments, and Although that's a part where they are a little bit ahead of Alphabet. If we look at the combined result, we see we get an internal rate of return of 12.4%, which looks very nice for me for a company with low debt, high free cash flow, high margins, huge buybacks, and a nice quarterly dividend. That's it for today. Thank you for staying till the end. If you want to see the analysis videos for the companies we just looked at, take a look at the pinned comment below and don't forget to subscribe to the channel.